When a massive market panic hits, liquidity vanishes in an absolute instant, and terrified investors scramble for safety. This diagram illustrates the classic defense mechanism against that panic, the 60-40 portfolio. You hold 60% in equities for growth and 40% in defensive bonds to cushion the blow when stocks inevitably fall. But we're sitting in a rare market anomaly. Across the board, almost all traditional assets are currently historically expensive. This chart plots the Shiller P/E ratio, highlighting an extreme peak for equities. Overlaying bond yields reveals near record lows. At these levels, bonds lose their mechanical safe haven ability. If interest rates mean revert, both metrics will brutally crash downward at the exact same time. Relying on outdated asset correlations during an everything bubble leaves your capital exposed with nowhere to hide. The unexpected alternative is cash. Yes, holding cash means you lose purchasing power to inflation over time, a mathematical drag that slowly erodes your money. Institutional wealth managers understand this. They do not view cash as a passive savings account where wealth goes to sleep. To them, it is an active, mechanical tool. The first function of this tool is the shock absorber. Cash has zero correlation to risk assets. When corporate earnings fall and the stock market spirals, a cash balance does not flinch. The second function is dry powder. In financial terms, cash acts as a call option with an infinite maturity. It grants you the right, but never the obligation, to buy underlying assets in the future. Accepting a slow, steady loss to inflation is the mathematical price of admission for ensuring your nominal capital base survives a major market shock. We can see exactly how this dry powder theory plays out using historical analysis from the asset management firm GMO, mapping strategies through the 2008 global financial crisis. This animated chart models two distinct subjects. Portfolio A, our static benchmark, holds a standard 60-40 stock and bond split. Portfolio B takes a dynamic approach, actively pulling 10% from equities into cash each year for 3 years leading up to the crash. Through the peak years of 2005 to 2007, Portfolio B falls behind. Holding 30% in uninvested capital creates a massive cash drag, causing it to lag the market by over 5%. For a professional manager, underperforming a raging bull market just to hold cash introduces intense psychological pressure and serious career risk. Then, late 2008 hits. Both portfolios drop off a cliff, but Portfolio B stops its fall significantly higher. That 30% cash buffer mathematically limits the depth of the drawdown. In the second quarter of 2009, right at the market trough, the strategy pivots. Portfolio B redeploys its preserved cash to buy deeply discounted equities. The final outcome of the cycle shows the cash hoarding strategy sweeping upward, crossing the benchmark, and ultimately generating nearly 15% more total wealth. The willingness to endure underperformance at the top of a bubble provides the exact capital required to fund outsized wealth generation at the bottom. If you look at modern portfolio allocations across the wealth distribution, ultra-high net worth investors consistently maintain roughly 8% of their portfolios in cash and cash equivalents. This baseline cash position is specifically required to support allocations in highly illiquid alternative assets, like private equity and venture capital funds. Alternative asset managers can issue sudden capital calls, demanding the committed funds to make a real-world acquisition. The investor must have liquid cash on hand to deploy instantly, regardless of what the broader stock market is doing. To the wealthy, a large cash balance is never the final destination. It is a temporary conduit, waiting for assignment. True capital preservation is maintaining the unencumbered flexibility to act, to buy, and to expand your holdings when the rest of the market is frozen in panic.